You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz. It's May 13th, 2021. Well, gold's hitting resistance, got whacked yesterday, but seems to be rebounding extremely nicely for now, up $10 the ounce, thereabouts, to around $18.25. Well, we're concentrating on the day-to-day, but we might be missing, you might be missing, I might be missing the larger picture. And for that, we're going to turn to our good friend Alasdair Macleod from Gold Money, and like to get your opinion on where you think gold prices are heading. So you can send me an email to my personal address, kl@kerrylutz.com. Well, Alasdair, when last we spoke, you said the dollar was basically in its last breath. And today you're telling me that the LBMA, and maybe that will presage the whole thing, but the LBMA is on its way out due to the Basel III limitations that are going to hit the European banks on or about January 1st, 2022. And it could even be earlier than that. These things have a way of having their effects felt prior to when they're actually being implemented.
Yes, indeed. I released an article today, which is published on the Gold Money site, which I would suggest your viewers read it twice, because it is very, very important. The Basel III regulations were basically produced by a subcommittee of the Bank of International Settlements called the Financial Standards Board, or Financial Stability Board, I should say. And really what they've addressed in Basel III is the systemic risk within the banking sector. And basically this means that they want to ensure that bank balance sheets are structured in such a way and risk is managed in such a way that you don't get, sort of, if you like, one bank destabilizing another and so on and so forth. So they're looking at various different markets. It's taken a long time to introduce this. Various aspects of Basel III have been delayed, but we've got final dates on, firstly, the European Banking Association are introducing the rules as far as bullion trading with Eurozone banks, European banks, and that would include the Swiss ones as well, who have to go with it. And that is from the end of June. So 10 member banks of the London Bullion Market Association in London are caught in this. As well as that, the Prudential Regulatory Authority, the regulator in the UK, will be introducing the Basel III changes as far as bullion banks are concerned on the 1st of January 2022, which means at the end of this year. Now, obviously, what banks do is they will adjust their behavior, their strategy, their balance sheets ahead of the event. They don't wait until the last moment. So this is relatively imminent, and it's certainly imminent as far as the Eurozone banks and the Swiss banks are concerned. Now, there has been a little bit of chat about this, but I think it's clear, it's important to know exactly what is involved. We're looking at both sides of a bank's balance sheet. Let's start with the liability side. Now, the liability side it includes things like the amount of equity in the bank. In other words, what is owed by the bank to the shareholders in the form of equity and form of anything else that is there. And that's set out as tier 1, tier 2, tier 3, whatever. And there's something called the available funding, if you like, from that side, the ASF, available stable funding ratio. Now, 100% basically is applied to something like tier 1 equity. Tier 1 equity, 100%, that means you can use tier 1 equity in total to fund anything on the asset side of your balance sheet. Fairly high in the list also are, if you like, sort of private sector deposits. So, a bank might have a significant portion of its balance sheet owed to individual depositors. That is seen as a relatively stable form of finance for a bank. So that, again, has a fairly high rating. What the FSB have identified is that if there is a risk, a systemic risk, then basically it is the interbank stuff which they need to de-risk. And part of this is the bank liabilities to other banks in the in the gold market. And we're looking at the unallocated gold market, not allocated. Allocated is not on a bank's balance sheet. That is held in custody. So we're only looking at allocated. The rating in which the available funding out of allocated gold on the liability side is 0. In other words, you cannot use a position that whereby you owe other people, whether it's banks or individuals, unallocated gold. You cannot use that to fund anything on the asset side of your balance sheet. On the asset side of your balance sheet, if you have an unallocated gold position, that gets a haircut of 15%. In other words, that's valued at only 85%. Now, this goes into a calculation where it must always be 100%. So what this basically means is that a bullion bank operating in the unallocated gold market, and the London market is totally unallocated. Don't confuse it at all with an allocated position. We're talking just totally unallocated. Unallocated is created out of bank credit. The creation of bank credit is used to create an unallocated position. So we're only talking about that. But so banks will not be able to offset, say, an unallocated liability with an unallocated asset. So you can see that when it comes to running a book, they can't do that. They can't offset one against the other anymore. And not only that, but there are huge financial penalties involved in running an uneven book. So what this basically means is that, first of all, you've got the European banks pulling out of the market at the end of June, and then you're going to have every other bank in London pulling out of the market by the 1st of January. It is possible it might be extended, but that goes against the spirit and the whole rationale of the thing. And I do know that this has been discussed, if you like, secretly, if you like, between interested parties for a considerable time. And I can tell you that the Bank of International Settlements, my information is that they are not going to backtrack on this. So this is about as firm as you can get, and you can understand why if you really examine the reasons behind it. Now, not only do we see London effectively closing down, the end of that market, and we're looking at a market which is 9 times the size of Comex, of the Comex gold contract, 9 times the size. Comex is where these people hedge their positions in London. And increasingly, what they have been doing is playing the game of, sort of fleecing the idiot money basically being hedge funds. And they have been doing this extremely profitably for some considerable time. But given that the bullion bank trading desks in London are going to close down, these are the same people running trading desks on Comex, what is known as the swaps category. The swaps are no longer going to exist. I mean, there may be some which aren't European, some which are not LBMA members. I wouldn't know. But I can tell you that virtually all the swaps, the swap members, that category on Comex in gold and silver contracts will not exist after January the 1st, 2022. Wow. So this is a major change in the market. Now, the implications are quite important, even from that, beyond this. The first thing is that this is happening at the worst possible time in the sense that dollars are being printed at an accelerating rate. In other words, fiat money is collapsing its purchasing power through sheer over-issuance. And of course, gold is where you would naturally go to offset this. So this is not an easy time for the swaps with short positions. And the short positions on Comex are in the order of about $24-25 billion between all of them. So that's a net figure which needs to be closed out. And it'll be closed out in the coming months. So that's very important. Also, when you look at the central banks' involvements, central banks have been leasing gold into the market for some considerable time. And there was an analyst, a highly respected analyst called Frank Veneroso, who looked at this back in at the beginning of the millennium. And in 2002, he produced a paper, which is actually shown on the Garter site, where he estimated that gold out on lease was at least 10,000 tons and could be as much as 16,000 tons. Now, that was at a time when central bank gold reserves totaled around about 25,000 tons. Today it's 35,000 tons. We don't know the size of the leasing in the market. It may well be less than that 10,000 tons because, of course, things have changed somewhat. But we have seen times when, for example, the Germans and the Dutch have decided to recall their gold not held by them, particularly from the Bank of New York. The Federal Bank of New York. And we could see that the Federal Bank of New York was unable to satisfy that demand, particularly in the case of Germany. So we don't know, but you can be pretty sure that there's quite a lot of gold double counted at a time when this paper market is effectively shutting down. And of course, there is the other aspect, and that is that the paper markets have been used, particularly by the Americans, to control the gold price by increasing the supply of paper to absorb demand. That has been a very important part of controlling the gold price, particularly following the failure of various auctions in the 1970s after the Bretton Woods arrangement ended. So the problem that we now have, or at least from a strategic point of view, is that if we are moving towards markets which are driven by physical, then obviously the pricing power moves from paper markets which no longer exist to China, which is by far, the Shanghai Gold Exchange is by far the largest gold exchange, physical gold exchange in the world. So there are lots and lots of implications that flow from this. One of these, which I think is very important to try and understand, is that we are having withdrawn from us paper supply, which is in the region of somewhere like $250 to $300 billion worth of paper gold is going to be withdrawn. Now, that supply goes. The question then is how much of the demand is going to then find itself, with no supply. And I think it would be wrong to say that everybody who owns an unallocated account with a bullion bank is going to automatically switch, try and buy gold, because he'll just end up with paper. But there is likely to be quite a lot of holders who think that they have got gold, exposure to gold through a bank, who find that their accounts are closed and have no gold and will want gold. Now, that is bound to drive the price substantially higher once people begin to realize the importance of this situation. So that is the article which I've written today, and I would advise anyone with an interest in the gold market to read it and read it a second time as well to really understand the full implications.
So, in other words, the emperor has no gold.
This is true. Perhaps I'm the little boy who points it out.
Yeah, well, it's been pointed out for a long time, and how anybody could really believe that that you're holding gold when you have an unallocated account. That's just believing in the tooth fairy. Just don't know how anyone is at this point in time, when we've seen all the fraud that has taken place in every aspect of the financial system, and certainly when it comes to the bullion banks and precious metals, How could anyone think that their promise is worth anything?
Well, I would agree. I mean, the answer to the question you effectively pose is that the establishment, by which I mean not just banks, but also the investment management industry and all the rest of it, for them, gold is not a regulated investment. So they can't actually really think in terms of owning bullion. They can sort of do it at arm's length a little bit through an ETF like GLD or SLV for silver. But basically, they have been educated that the world is fiat. They don't understand, how gold works. They really don't understand it at all. And consequently, they've ignored it. Very, very few portfolios have any gold in them at all. I mean, occasionally they will speculate maybe in a mining stock. If their chart says that gold is going up, then okay, well, let's go and buy some shares in a decent mine. But, always this is with a view to selling it. And that is, if you like, an investment criteria. Whereas, the way to look at physical gold is you're not investing in it, you are buying it to spend it, and you will spend it when fiat currency goes down the toilet. And that is the point, and it's the point which nobody in the establishment, by which I mean not just government, not just central banks, bankers, investment managers, and all the rest of it. That is the point they don't understand.
All right. So you mentioned GLD, and we might as well bring up SLV. We don't really know if they're holding the metal either. I mean, their fluctuations on the number of ounces on hand are like enough to fill thousands of armored cars around the globe. And we know that the sub-depositories specifically written into the regulatory documents, the SEC documents filed, don't provide for any audit of sub-depositories. So if the whole scheme collapses, can gold and SLV be far behind?
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Well, it's a difficult one, this, because the custodian appoints sub-custodians, obviously, but the custodian does have responsibility to ensure that the sub-custodians actually do hold on to the silver. The problem is, I mean, when you get demand for silver suddenly, and you're looking like maybe a couple of 100 tons or maybe 1,000 tons of silver being shifted into the custodian's control, either directly or indirectly. I mean, you're talking about huge numbers of bars. And, you can't actually check every bar as it comes in. So I suspect that what they do is they rely on a metals audit once a year or maybe twice a year. But when it comes to bars being shifted, this is just book entry stuff because there's no other way of doing it. There really isn't. We had this also with GLD in the sense that we found suddenly that the Bank of England was in the position of a sub-custodian. And it was quite obvious that there was a shortage of stuff in the market. And it was one of the authorized participants had to obtain the gold from the Bank of England, which was leased from another central bank. And of course, when gold is leased from another central bank, they're not going to move it out of the Bank of England. They're just going to leave it there. And it registers in GLD's list of bars as being held by the Bank of England. So, this is an interesting situation. The whole way in which the system runs is riddled with inconsistencies, and we just hope that everything is there. And this undoubtedly is not as nearly a good position as having, physical gold or silver under your personal control, or at least stored in a regularly audited custodian provider, which is not a bank. You've got to get it out of the banking system, because when the banks go bust, you can whistle for it.
Hey, I could not agree with you more. What does it say in the Bible, Alasdair? Possession is 9/10 of the law.
Yep.
Yeah, well, that's a slender reed. Rest your gold possession upon a legal doctrine, because that's all you're going to have is legal mumbo jumbo to basically assert your claims against banks that might not even exist anymore in their current form, right?
Exactly. Absolutely. You got it. And the other problem is that, when things really cut up, like, currencies are collapsing and all the rest of it, governments begin to lose their respect for property rights. And that's another aspect which you've got to be very, very careful and wary about. Which is why, at Gold Money, we have vaulting facilities all around the world. So an American citizen can vault his gold, say in Zurich or Singapore or London, wherever he wants, and he can also vault it in a vaulting company which isn't American. So in other words, the American government can't turn around to a foreign vaulting provider, say in Zurich, and say, "Thou shalt do this." But it can do it in a vault in America, and it can do it with a vault owned by an American organization. So these things, I think, are very, very important to understand. I'm not saying that people should break the law, just make it a bit more difficult for your government to take your property.
Yeah, well, we still have, for the time being here, Alasdair, the Second Amendment. And I don't know if it's going to do any good or not, based on the latest erosion of civil liberties here in the United States due to that illness that I heard is going around. Seems like people just voluntarily gave up their rights, and it's happening in Canada. It's happened in the UK. It's all over the world here. So I don't know if this is going to be the straw that breaks the camel's back and really ushers in another dark ages, but it sure looks like we're heading towards one.
Yes, I think you're right, just the whole thing. Governments now have us as providers of money, if you like. They're taking more and more control over our day-to-day lives, and when you sort of read the stuff that comes out of Klaus Schwab, in his Davos thing, you can see what, basically the end point is exactly what Marx was trying to achieve. He wanted to rule the world and own everybody's property.
Yes.
So, that is where that is going. And you have got major companies, supporting him. This is completely wrong. It is crazy. It won't work. And the whole system will collapse before they get anywhere along that line. And it'll collapse because they're ignoring one thing, and that is human action.
Yeah, human action, which was the title of the great Ludwig von Mises, his seminal work, Human Action, because economies don't really exist. All that exists are humans acting to further their own interest. They're at the expense of someone else or at the benefit, but nonetheless, we all act accordingly to advance our own interests, hopefully within legal and ethical and moral confines, but many times not. And certainly governments and their representatives have stopped acting in anyone else's interest but their own a long, long time ago. So I find this all fascinating because it's going to precipitate what I guess the inevitability that we've been experiencing really for over a century, perhaps, but certainly since more recently, since the crash of '08 and '09, it's kind of led to this inevitability. So we'll see how happy people are when they have nothing and only the government to support them. We'll see if that they're going to be happy in the state of affairs. I would prefer to think not, Alasdair.
I think it's going to be actually pretty tricky. What happens when currencies collapse and the dollar is on the way to a collapse? I mean, it's very early stages, but it is collapsing. And basically that wipes out the middle classes. And these are the people that you and I talk to. And they don't realize it. I mean, how many people are actually running out and buying physical gold and silver? Very, very few.
They're busy buying Dogecoin, right?
Yeah, yes, that as well.
Hey,
and that's an interesting one, Kerry, because they bought half the story. They understand that Bitcoin's rate of issuance is considerably less than the rate of issuance of the US dollar, and therefore that should go up. But they haven't bought the other side of it. They don't realize that what they're doing is they're selling dollars to buy Bitcoin with a view to selling Bitcoin to buy back dollars. Hold on, that's not going to work, is it? If you see what I mean.
Well, so they'll buy SDUs with them. Yeah. The problem with Dogecoin and a lot of these cryptos is they have no caps. So the issuance is unlimited. So I've come up with a solution, because if you remember back to the collapse of the mark in Germany during the 20s, people had to take wheelbarrows full of currency to try to buy a loaf of bread, and then they'd steal the wheelbarrow. So I've come up with a solution to this. It's called the digital wheelbarrow. So when your crypto is totally hyperinflated, you'll be able to carry it around in a digital wheelbarrow, which, because a wallet won't work anymore, it isn't big enough.
I like the concept.
Yeah. Well, maybe that's what we're heading for. Not to say there isn't a place for crypto. I've got small positions in it for the heck of it. And that's not to say that it's not going to survive the fiat currencies either. The question is the relationship of precious metals to cryptos. Where is that going to wind up? That I find fascinating.
Well, it is actually, the answer is very, very simple. And you have to bear in mind that no central bank owns any cryptos. They're looking to produce their own form of cryptos. They don't own any cryptos. Certainly, they don't own any distributed ledger cryptos, but they do own gold. So when your currency starts to disappear down to nothingness, the only thing you can do to save yourself and save your government and end up with the politicians actually being paid something at the end of the day is you have to tie your worthless currency to gold, because that's the only thing you've got. Now, at that point, some central banks won't do it properly. That is understood. But basically, they will learn that the way to do it is basically you've got to have a standard which allows people to have coins, gold coins, silver coins. And not only that, but the economic side, government's role in the economy also has to be addressed, and that has to be reduced substantially, like down to below 20% of the total economy.
So Jeffersonian levels here, or even even that high for Jefferson, but yeah.
Yeah. So going on with the story, the moment gold is there as backing the currency, then the raison d'etre for something like Bitcoin finishes. It's gone. That's it. So what I would say is that the moment that governments actually do move towards backing their currencies with gold, making them proper gold substitutes, then the whole of this sort of crypto speculation is dead and buried. It may happen before then, but it then has no use whatsoever. Just imagine, people sort of arguing that Bitcoin is the new money. Okay, let's assume it is the new money. How is a business going to invest in production using Bitcoin? How can it work out? We've got to have so much capital to take it to the manufacturing to the point where I begin to earn money through sales. What's going to be the value of the sales of the product in 2 years' time, measured in Bitcoin? It's probably going to be considerably less measured in Bitcoin than it is today. So what am I going to pay in terms of interest? I mean, the only way it'll work is a heavy negative interest. I mean, so a bond market working on heavy negative interest rates to counter the deflationary effect of a completely inflexible money. It's complete nonsense. It's unworkable. As simple as that.
Yeah, well, you might very well be right. Unfortunately, I think we're going to find out the hard way, because the one thing we learned from history, as I'm fond of saying, is that we don't learn from history. All these experiments have been done. You can't just create something out of nothing. I mean, it'd be nice if you could, but it just doesn't work that way. And unfortunately, we're going to learn the lesson, although it could be a very bitter one. And hey, as far as gold versus silver, so in this world you're describing, what happens to silver value-wise compared to gold?
Well, silver, when gold is money, then silver will also become a subsidiary money to gold. And I think what we're looking at is probably not Isaac Newton's sort of 15.5 to 1, but I think we could be looking at a level, say, somewhere between 20 and 30 to 1. Now, it's difficult to know at this stage, but if that is the case, then you've certainly got a substantial outperformance by holding some silver compared with gold. And I think that does make a lot of sense. I mean, silver doesn't have the above ground stock, which gold has, because it is consumed. It's an industrial metal, and it's being valued as an industrial metal. I mean, it's up there with other metals like copper, for example, in terms of how it's performed since the Fed went all in back in March last year. Gold has hardly gone anywhere. So you can see that it's not being valued as money, it's being valued as an industrial metal. But I think it's still got a long way to go. I mean, at the moment, the gold-silver ratio is about 67. I think that's going to at least halve. The quicker that the dollar goes down and takes other fiat currencies with it, then the quicker silver is going to go up, and it'll go up at twice the rate of gold, roughly, which it has been doing over the longer term. It's about twice as volatile as gold. So I see that continuing.
All right. Well, you've brought up a lot of interesting issues. I'd like to know what all of you out there think about Alasdair's hypothesis. Maybe it's more than that, but what do you think about it? LBMA out of existence, and if that happens, kiss the Comex goodbye as well, and then a cascading effect, perhaps. What do you think? Send me an email to kl@kerrylutz.com. It's been a pleasure as always, Alasdair, and you can find the full article over at goldmoney.com. We'll have a link to it in the show notes as well. It's definitely must reading. And we will talk to you again. I'm sure a lot of ruminations and a lot of stirrings are going to take place between now and the end of the year. And not like somebody's going to turn on a switch on January 1. There's obviously going to be a dawning realization to the, certainly among the world's financial institutions, and no doubt among its citizens. So let's see where we go from there. Any questions, comments for Alasdair, myself, send me an email to my personal address, kl@kerrylutz.com. And make sure you sign up for your free newsletter at Financial Survival Network. Alasdair, always a pleasure. Thank you so much for coming on.
That's very much my pleasure, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.